Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at phys-empowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
Good day, everyone. So thank you and joining us for another very interesting episode with our Physician Empowerment podcast and a live webinar. And so today we're going to talk about private equity, what it is and why, what is its place in the weatherproof or all-weather portfolio. And so we're really, really glad to have Josh Carter to join us. And so thank you, Josh. And let me do some orientation, right? I think all the more people are thinking about this all-weather portfolio. And actually, that was the topic of our last masterclass last month. We actually formally addressed Ray Dalio. If you guys want to look him up, Ray Dalio has this book and actually had a fund. And it's actually all-weather fund, right? So it doesn't matter what weather it is, you protect it, right? And of course, this weather is metaphorical for the outlook of your financial portfolio, or your hard-earned money, push into a golden basket of eggs. And so if they're all in one asset class called the public stocks and bonds, poof, right? One of it's plus 30, minus 30. And lately we have seen a lot of that, right? Josh, I'm sure you're in the space, right? And you see the ups and downs. People got very nervous. With recent geopolitical changes, it becomes really, really scary for a lot of people. And so people are looking at, what do we do? Do we cash in all the chips? And of course, that is not really the smart way to do that, right? You don't want any idle money going. So before we dig in, let's talk about you, Josh. So again, thank you for taking time to join our podcast and webinar. So you are a CFA, Certified Financial Analyst, and a portfolio manager, and you're an investor relationship. So how does a guy walk into that space?
Yeah, no, it's a great question. Like for me, my kind of personal journey to get into it, actually originally, I know we chatted about this beforehand, but I originally wanted to kind of go into the medical field. I wanted to be a physiotherapist. And for me, I knew I liked working with people and I wanted to kind of grow a business, be a bit entrepreneurial. And so I shouted a few people in the industry and I quickly realized that physio probably wasn't for me, but those two attributes still were something that I wanted to pursue. So for me, I've always had a really big interest in the markets, in personal finance, how to optimize different aspects of your life. And so kind of, shadowing a number of people in this industry, it was a really good fit. I'm passionate about the markets. I think being able to be involved with individuals long term and having a kind of an impactful relationship on their finances, for me, really struck home as a big reason why I'm in the industry. And so it's been fantastic. I've been in the industry for about 6 or 7 years now and love it.
Right on. Now, so you are truly the numbers guy, right? Like you guys dig into the weeds, right? The weeds of the markets. So, and then of course this all-weather portfolio. So what's your take? Why is this so relevant now? We need to look at something other than stocks and bonds. When my wife was actually a financial planner for a very short time before we got married, and thank God I got out of debt very quickly because of that. And at that time, it's 60-40, 70-30. That's all stocks, bonds, done, go home, right?
Yeah.
Now, why are the big funds like pension funds, hedge funds, endowment funds, family offices are these big dogs, right? And they all don't just play in those sandboxes, they play in others, like alternatives. Can you enlighten us? What are these alts, or what are we talking about?
Yeah, no, so it's a great question. And, I'm glad you brought up kind of the big players, the billionaires, the pension funds, the endowment funds. We often refer to that as call it the smart money. And we like to refer to it as the smart money because number one, there's a lot of people working for that money, right? So they have a lot of expertise, a lot of experience. And then number two, the dollars are very big. And so for, overwhelmingly across all these very successful kind of very big, call it smart money kind of groups, overwhelmingly have a big allocation towards private markets and alternative markets. And so similar to your point before, the stock market has a lot of up and down, and we've seen that pretty significantly over the last, it's probably increased over the last 10 years or so. There's a lot of ups, there's a lot of downs. And so we want, if we just look at all the investable asset classes in the world, there's a lot more than stocks and bonds. And so by investing kind of in these private or alternative asset classes, we can build kind of a more robust portfolio, or like you mentioned, an all-weather portfolio. From our perspective, with investing, there's always uncertainty. But the one certainty that there is with investing is that there's going to be something that comes up that we don't expect and we can't predict, whether that's COVID, whether that's tariffs, whether that's obviously right now we're seeing some geopolitical conflicts around the globe. And so by investing and building an all-weather portfolio, we're able to mitigate a lot of those risks. And like you said, not have all our investment eggs just in one or two baskets. It's spread out between 5, 6, 7, 8, 9 baskets. And so they act independently, which is really the kind of the purpose of doing it that way.
Right. So in the name of true diversification, right? So then there's a concept called non-correlated assets. Can you kind of unpack that term a little bit for us?
Yeah, it's a great point. So uncorrelated would just essentially mean it behaves in a different manner. It's affected by different things, affected by different risk factors. If let's take, for example, something like a toll road, for example, which is an investment that you can own. It's an infrastructure investment. That's going to behave very differently because a toll road, the investor of the toll road, essentially makes money regardless of what's happening in the economy or in the world. As long as a car drives through that toll road, they're going to pay a toll, and the owner of the toll road profits from that. Tariffs could be announced, or there could be some geopolitical conflicts. And while that sure affects a lot of things, as long as people are driving on the toll road, that investment remains unaffected. And so having, call it diversified assets like a toll road in the portfolio or some other uncorrelated investment is really good. That's what we want to see, right? We want to be able to not be at the whims of, if we look back over the last few years, especially with politics in the US, I remember a few times where the president would tweet something and markets would react, whether it be positive or negative.
Real time.
Yeah, that's right. And so we want to be able to build a portfolio that it's not at the whims of something like that. It's a little bit more consistent, more stable, and also reacts to different things, is affected by different risk factors.
Right. So we see two kinds of practitioners, right? Healthcare practitioners. The ones that they just say, I'm too busy. I just want to practice whatever I go to school for. I just give it to some salespeople and just make me rich, right? They totally don't know what's happening, right? And they allocate and abdicate their rights, right? So they don't know what's going on. The other type is like, I'm going to nerd it. I'm going to DIY it, right? So I've seen people drop their shit and just hide under the cover of darkness, 3 big screens, and chase crypto.
Yeah.
Right? And there are lots of those dudes. You and I both know those dudes, right? And they hit it pretty good last year, and so went into gold, right? Like you name it, right? You name it. They're different asset classes, right? And in the name of diversifying or making them all weatherproof, they expend a lot of personal effort. And at the end of the day, there's no peace either, right? Like you say, right? They always have to worry about this, right?
Yeah.
Worry about this, worry about S&P, worry about the different candles, the green candles, red candles, right? I've seen views like that too, right? But when you say toll road, hey, oil dollar 100 versus 85, people are still going to pay that toll, right? Drive through.
That's right.
So that's okay. I think that's whetting everybody's appetite. Next question I have for you. Why is it called private equity? What's so private about it?
Yeah, no, it's a great question. So within the investment space, you have public investments, which essentially are available for anybody to buy or sell, right? If you open up an investment account, you can go buy shares of Nike or of Apple or of Facebook. And, it's very accessible. But if we look at everything that you can invest in the world, like if you walk down any city that you live in, You walk through the downtown or the neighborhoods, most of the businesses that you see are actually private businesses. We hear a lot about the public businesses, but there are significantly more private businesses in the world than there are public businesses. And so private equity is essentially just a term for investing in those private businesses that, are probably a little bit harder to invest in for a couple of different reasons, and we can get into that. However, oftentimes these private businesses, if selected correctly, can do very, very well and can be a great piece of the portfolio. But that's kind of the difference there is, it's not necessarily available for anybody to come and buy and sell.
Right. So I guess the perception is if a company has gone public, that's got to be a huge company. Of course they are, right? But for the ones that did not do the IPO route, there's what they say 10 times, 100 times, 1,000 times more companies that are doing well. Some are not doing well, but they just decided not to do that or before they do that.
Yeah.
Right? So there's a lot, and a lot of them make a lot of money too, and they were ready to raise capital and share their wealth.
For sure. And even to further that point, Wing, so if we just filter for companies in the world, both public and private, that make over $250 million worth of revenue. So it's to say very big established companies. If you're making over $250 million of revenue, you're pretty big. 86% of those companies are private and only 14 are public. So there's a lot of opportunity, even in, in well-established, good, solid performing businesses. And so by investing, call it in an all-weather or accessing this private equity, allows us opportunities that are not normally accessible.
Right. For example, I invest in REIT, right? Real estate investment trusts. And people say, wow, REITs, it's still correlated. Well, I buy private REITs, right? That is really not directly correlated, right? Because they don't want to be public by a knee-jerk, by a Twitter from the president, and then boom, your portfolio just goes upside down, right? Yeah, so that's
right.
Cool. Now, okay, let's deep dive into that. So why do they pay investors more than the public dudes? Like, why?
Yeah, no, it's a good question. So from a return standpoint, historically, private equity has been very competitive, right? Especially the public equities. And there's a couple reasons why that is. Oftentimes these private companies, they don't have as much governance from an audit standpoint. Like public companies have to report every single quarter. They have to follow a number of governance issues. And two, there's a lot of overreactions and underreactions in the public markets, right? Because the stock is, there's fundamentals and whatnot, but essentially it's, the price of the valuation is what you're willing to sell it and what I'm willing to buy it at. Whereas in the private market space, there's a little bit more room for these private businesses to make changes and tweaks without having some of those kind of audits and governance that's in the public market space. And so they're able to move a little bit quicker. But then also too, from kind of a pricing and a valuation standpoint, those companies, there's a little bit less knee-jerk reactions. They have time to process that information. There's probably a little bit more inefficiencies that you can capitalize on in the private markets as well, which we've obviously seen. So I'd probably say kind of based on those two factors, that's kind of why we see some very competitive, if not higher returns in the private equity space.
So how much do you think, would you say, just broad brush, right? Of course, it depends on your client portfolio, what's your risk tolerance and all that, right? That aside, if everything the same, right? The public equities, people say, oh, low risk, they get a certain percentage. Private, they get higher. How much higher would you say it is?
How much higher in terms of a percentage gap?
Yeah.
So there's a number of different studies you can go out and look at. The most recent one, it's actually in one of Tony Robbins' books, I believe his most recent book about private markets. And they did a study where they looked at private equity funds versus public equity funds since 1986, I believe. And I believe the return for the market, so the stock market, was about 10% and give or take. And the return on a private equity fund was about 14%. So some slight outperformance there. And over 30 years, that can actually be quite significant. And I believe the don't quote me on this, but I believe the returns were net of all the fees that were paid. So that was what the investor actually experienced. And so over a 30-year period, that performance can be quite significant.
And you know what? At the end of the day, as a customer investor, that's what I care. I don't care what the gross they perform is. You got fees. I need to know net of fees, right? And
Yeah.
of course, after that, after tax, right?
Yeah.
And it's different discussion with the tax efficiency. But of course, yeah, at the end of the day, if that's even a couple percentage difference, that's really
Yeah.
worth everybody's attention, at least.
For sure. And it's like you bring up a good point. Oftentimes, like in these private companies or private equity funds, people often say, okay, well, the fees could be slightly higher, which, that's probably a valid point. But most of these funds, how they function is there's a certain percentage they need to surpass in order for that private equity fund or investment to actually take some of that profit. And so it's actually a good thing if they hit that, because that means your investment is probably doing north of 8 or 9 or 10%. Then there's a bit of the profit that you share with essentially the manager of that private equity piece. And so it's a good thing. It's not necessarily a bad thing.
So let me just expound on that just a little bit, because I do a lot of real estate. We do private equity raise. So it's an incentive for the general partner, right? In a lot of these things, right? To incentivize them to hit what we call, or what they call, a hurdle rate, right? So you get certain percentage if that portfolio does so. But if they hit some high water mark, they call it, boom, then you get more, and you incentivize the manager, right? Or the sponsors to actually get more. And so everybody wins.
Exactly. Yeah. No, you got that exactly right.
Cool. So if that's so juicy, why don't we just jump all in, right? What are the risks and downside of
Yeah,
this
so
kind of stuff?
it's a great question, and something that investors should be very well aware of. I would say, from my standpoint, there's a couple things to be aware of. So first off, when you invest in private equity or a private company, typically your money's going to be probably locked in for a little bit of a longer period of time, right? So if you're investing in a private company, those dollars, are going to be used for 3, 4, 5, 6, 7, 8 years. And so unlike the public markets where you can buy and sell the same day, those private equity transactions typically are not as liquid. So that's one. There's obviously solutions to this, and we can talk further about that we've been able to mitigate kind of through the company I work for. However, that's something to be aware of. And then I think the other kind of important thing to think about is, especially when we're investing in private equity, the dispersion between the top performing private equity investments and the bottom performing private equity investments is actually quite large. So unlike, and I wrote down a couple numbers just to give you some reference. And so when I say dispersion, what I mean is kind of the difference between top performing, bottom performing. And the study that I've kind of often referenced takes a look at the 75th quartile versus the 25th quartile. So in public stocks, the 75th quartile, and this is global stocks over the last 10 years, has done about 8.9%. The 25th percentile has done about 7.2%. So that the dispersion's fairly narrow there.
Very narrow. Yeah.
So there's not, there is, you want to make sure you're investing kind of in the top tier, but even if you were to miss that and invest in the 25th percentile, you're not doing too bad. Whereas if we look at global private equity, the top 7 or the 75th percentile, the return is 21.4%, while the bottom 25th percentile is 1.5%. So
wow,
that dispersion,
GIC.
yeah. So the dispersion is a lot wider in private equity. And so it becomes more important that you make sure that the quality of the private equity investment you are getting yourself into is top tier. And so that's something you should be mindful, because there's lots of private businesses and there's lots of different options for investors, but call it the due diligence, or who you're working with or how you do it, is increasingly more important than it is in the public stock market.
Mm-hmm. So you mentioned that it's private because not everybody can play, right? Unlike public stocks and bonds, right? You have to be accredited, or at least eligible, right? The different tranches you have to qualify for, right? So the subset of investors are smaller. Now, of course, all of our audiences would qualify for eligible and accredited somewhat even above, right? And so it's a different space, and they do tend to find us, seek us out, right?
Yeah.
Those people, right? So now we're down on that path, the shady part. Let's talk about something shady. Lately, there's some bad press about private equity trust space, right?
Yeah.
There's something. So can you help us unpack that a little bit?
Yeah. So I mean, and within a lot of different asset classes, you're going to see some bad press, whether it's about the private equity trust space or whether it's about real estate or whether it's about, and I think kind of the overarching thing to be aware of is oftentimes it does not, it's a blanket statement for the whole asset class when it really only affects, call it a small segment of the market. So for example, like the private equity trust, like I know there's been in the news a little bit of kind of noise about the assets being priced lower than what the NAV price is at, which means, there's the private equity fund is saying that it's worth more than it actually is, which in some cases, and kind of goes back to my previous point about the dispersion, the top quality or the top tier managers, you're probably going to be able to avoid most of those issues. Whereas this is probably more of an issue kind of in those bottom tier. Another kind of segment of the market right now that's getting, call it a lot of bad press or a lot of negative connotations or negative news is the private credit market, which especially specifically in call it the software segment of that market.
That's right. Yes.
Yeah. It's really affected the software segment in terms of the private credit and even some of the private equity, but it hasn't affected the rest of the market really. And so just like real estate, you've got residential real estate, office, industrial, raw land, this might be affecting something, for example, like the office segment, but industrial is still performing very, very well. And so that's why it's important to be diversified is, there is probably, in everything, there's going to be some bad press and some bad apples, but it's just important that you have that spread out across different industries and across, different sectors of that industry to be able to mitigate a lot of that.
Right. Exactly. So there you go. So I think the understanding, the deep market understanding of an asset and asset classes are very important. Even 2008, the big subprime mortgage thing. Well, not every mortgage is subprime, right? But because they packaged subprime and just kept repackaging them and selling them. And in Hong Kong during those days, they were sold by the tellers at the front end like a GIC, right? And my mother-in-law lost like most of her lifetime saving, like it's real, right? But it doesn't mean the mortgage industry is a crook, right?
Yeah.
Right.
No, totally.
So now, okay. While we're there, let's go for it. It's not just bad press now. How about bad blood on the street? So I told people that I was involved in the private equity space before they were the form of EMD, Exam Market Dealership, in the mid 2000s. It's called a Wild Wild West. And I belong to an investment club, and money just pouring. And we're raising double-digit million per month. Right, mid-Wednesday, 550 people show up at a downtown hotel, and millions got raised per evening. But then the greed came in. There's a lot of bad blood, right? So I witnessed my kids' school teachers' lifetime savings gone. Like we had a lot of our investments went into courthouse. We're still fighting some of those. And our tuition is 6 to 7 figure, and lots of people lost their whole life. So there's a lot of bad blood in this space. And so how do we mitigate that now? Of course, Securities Commission, like there's a lot of compliance, right? Guardrail. So you're in the space. Tell us how naive investors got protected by the government.
Yeah, no, it's a good point, and something that investors should obviously be aware of as much as they can. So the first thing I would say, it's important to know who you're dealing with. So for example, in the exempt market kind of dealer space, the individual that you're probably going to be working with, you should be aware of what their commissions and what they're being paid, because oftentimes there's a heavy upfront commission for them, and so they're incentivized to get you to put the most dollars in something so they can get a big payout. there's not necessarily what we would call kind of a fiduciary duty or responsibility. They're really just transacting and selling a product. And for listeners, I'm sure most listeners know what fiduciary means, but from an investment standpoint, it's making the best suitable recommendation for that specific client in their scenario, right? So in their circumstance. So that's based on their income, their age, their net worth, their investment horizon, their goals, objectives, their tolerances, and their abilities. Whereas for, an exempt market dealer representative, they might just be trying to push a product. So I think that's the first thing to be aware of is who you're working with. You probably want to work with a fiduciary, and you probably want to work with somebody who's got some credentials and has been in the business for a little while with a bit of a track record is kind of the first thing that I would point to, And then the second thing with the exempt market dealer space is oftentimes like I was kind of alluding to before, the quality of those private investments vary significantly. And so you want to be as close to the smart money as you can be. Because, if you look at the CPP or family offices of billionaires, they're not necessarily investing in small mom and pop projects here and there. They're investing in things that are a little bit more robust, a little bit more developed. They have the right expertise and resources. Whereas oftentimes in the MD market, you're going to find very concentrated investments locally and also within kind of the asset class. And the expertise isn't necessarily there. So that's kind of the second thing I would say about the EMD market is just be aware of the quality of the specific type of investment that you're actually going into and purchasing.
Right. So that's a very good word, concentration. So of course you are one of those guys as a gatekeeper, right? So tell us what concentration means, and when would you say no to the investor and say you're too concentrated?
Yeah, no, it's a great question. So concentration would just mean kind of like we were talking about before, all your investment eggs would be in one single basket. And so, it can be great, but it can be horrible. And in most times, it probably doesn't work out in your favor because you have to be able to select the correct investment and correct, investments within the right investment space with the right time. And so it can be quite challenging to do that. Just to kind of give you some food for thought, the stock market overall, it's very hard to beat the index because to pick the top performing names that outperform the index has been shown to be extraordinarily challenging. Whereas if you were just to buy kind of the broad base of the diversified kind of everything, you're getting a much more balanced mix or much more diversified mix. And so the big question is, am I over concentrated? And so what you probably have to do is take a step back and kind of look at everything all together, right? Oftentimes people will own their home, maybe they'll have a pension, maybe they'll have investment account through their work. Whatever the case may be, you just probably want to make sure that if one specific segment of your kind of net worth or financial picture were to be, call it underperforming or not doing so well, that you'll still be okay. And so you can look at that from a net worth standpoint, and then you can dive even deeper and look at that from, call it a liquid investment standpoint. So your investment portfolio, how is that diversified? Do you have too much concentration in that? And from my perspective, I'm a big believer that you should have private equity in your portfolio. You should have infrastructure. You should have real estate. You should have stocks. You should have bonds, because it's much more diversified, and you're not at the whims of kind of one of those specific asset classes.
Right. Exactly. Yeah. So, well, this is really good. Now, so then I'm going to shift gear, and this is going to be the final question for you. I want to shift gear a little bit. So you have a CFA designation. You portfolio manager, part of a committee to pick different private equity entities, right? So how do you guys, with your big brain, your data analysis, how do you guys decide? Is it a hunch? Like how do you guys pick?
Yeah, no, it's a great question. So from our standpoint, like I sit on an investment committee, there's 11 other individuals in the room. And we like to look at we're very client centric, right? And so we want to make sure that the investments are suitable for our clients. And so taking a look at, we might have an amazing investment in infrastructure, but we can't have just a portfolio of infrastructure. And so first off, we want to make sure that the balance between those asset classes is appropriate. So that's kind of the first step is taking a look at the asset allocation and making sure they have a good amount of real estate, a good amount of stocks, a good amount of bonds, a good amount of private equity. And then when we dig a little bit further into it, how do we go about in assessing if a private equity investment is a good fit or a good thing to put inside the portfolio? And so you call it, we manage things by committee. So the due diligence process for us is very important. We've got a chief investment officer, obviously. And so oftentimes when an idea is brought up, we want to make sure that idea has legs, not just right now, but that over the next 5 or 10 years, that's going to be a very good investment opportunity. We're not in the business. And then I think most investors are probably in this boat where they're more buy and hold. They want to be able to buy something, have it grow in their portfolio for the long term. And so that's an important kind of criteria for us. And then we want to make sure, especially within the private market space, that the right expertise is in place. So the investments in the groups that we're working with have done this for a little while. They have the right credentials. They've done a very, very good job. For example, let's take toll roads again, because I know we spoke about that earlier. I'm not an expert in toll roads. I don't know how to value one. I don't know where the best toll road is, but you want to make sure that if you're investing in a toll road investment with a group or a private equity fund, that group has the right experience, that they've done it before. There might be a previous vintage that has done very well. And so you want to make sure that kind of those boxes are all checked, which is another really important factor. And yeah, so I would say those are kind of the ways that we sit down and evaluate what should go in our portfolios. And, occasionally there's investments that have kind of run their course and also need to kind of be recycled. And that's part of investing as well. For the most part, they're buy and hold, but occasionally markets shift and change. And, for example, 10 years ago, AI was something that, we didn't know what the effects of AI were going to be. And now if you look at software, is software going to be a great investment for the next 10 years? I don't know, but we're a little bit more cautious about that. And so we want to be aware of what's going on within the portfolio as well. And, maybe want to change a name out here or there.
Right on. Well, this is really good. So final thoughts. What would be one final thought you give it to our listeners? If they're new to space, they never heard about it, they're busy professionals, what's one final thought you would have said to them?
Yeah, I would say, like, from my perspective, what I really like about the private market space is it's not something that's been recently invented. This is something that's been done for decades before. Like you look at a portfolio of a billionaire, and typically 50 to 60% is in private assets, if not more. Like you look at the CPP or some of these big endowment funds, and a significant portion of their assets, usually around 60%, are in private investments. And so I think it's a really unique asset class. Like I still really like public stocks and public bonds. They're great to have in the portfolio, but you kind of need, from my perspective, there's a bit of a gap that needs to be filled with some of those private asset classes. Like if you look at stocks in the 1980s, there was close to 8,000 publicly traded stocks. And now there's just under 4,000. So it's shrunk by half. So there's less stocks out there and kind of continue to decrease. And so there's lots of other opportunities. It's just important to be cognizant and work with the right type of person when you're getting into this space, because there's just it's a little bit more nuanced than the public stock market. Will kind of be my closing thoughts.
Wonderful, thank you. Yeah, so here at Empowerment, we want to empower you, the audience, to ask smarter questions to your advisors, right? So that's why we have the platform, but really privileged. So Josh, thank you. This is very fun, very enlightening. I'm sure we'll be inviting you back again. So thank you very much, Josh.
Yeah, thank you. I'd be happy to come back.
Thank you so much for listening to the Position Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at phisempowerment.ca, PHYS empowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@phisempowerment.ca. Thank you again for listening.